This really is shaping up to be a commodity supercycle 2.0. 5 major banks are now sitting on positions they mathematically cannot escape, and the metal they promised to deliver has vanished from the vaults that were supposed to hold it. You cannot buy 4.4 billion ounces of silver. It just doesn't exist. Cue the fire. We might actually have an insolvent bank. Truth be told, joke's on them, they're all insolvent. The financial world was witnessing something extraordinary, something that hadn't happened in decades. 5 major banks were now trapped in positions they simply couldn't escape from. The metal they had promised to deliver had disappeared from the vaults that were supposed to store it safely. The situation was becoming impossible to ignore. A trader sat at his desk, reviewing classified reports that had landed in his inbox. The message was clear. Don't share this with anyone. But the numbers told a story too massive to hide. He couldn't buy 4.4 billion ounces of silver even if he wanted to. That amount simply didn't exist anywhere on Earth. The fire alarm was ringing, and everyone was about to notice. The banks had been playing a dangerous game. They thought they were clever. They believed customers would never actually demand their money back. But they were wrong. Dead wrong. The truth was simple and terrifying. Every single one of them was insolvent. None of them actually had the money they claimed to hold. It was all smoke and mirrors. A classified UBS report had surfaced, marked as urgent. It revealed an existential crisis brewing inside Switzerland's largest bank. This wasn't just about UBS anymore. The entire financial system was at risk. Someone had checked the numbers on UBS's short position. The figure was staggering: 5.2 billion troy ounces of silver. To understand what was happening, imagine walking into a restaurant. You hand over your coat and receive a ticket in return. Simple enough, right? But now imagine the coat check attendant had issued 35,000 tickets. The problem? He only had 100 coats hanging in the back room. That's exactly what these banks had done with silver. They had taken enormous short positions, betting that silver prices would fall, but if prices went the wrong way, everything would be wiped out completely. The risk was infinite. Silver prices could theoretically rise forever. There was no ceiling, no limit to how high they could go. Right now, these banks had 1 coat and 350 people demanding their coat back immediately. Breaking news alerts were flooding across every financial screen. Headlines screamed the same message. Silver shorts burned alive. Reports emerged that a major bank had been stopped out of a multi-million-dollar silver short position at $78 per ounce. The internet exploded with speculation. Had TD Bank gotten stopped out at $92? Silver had already hit that level and kept climbing. But TD wasn't alone in its troubles. Everyone was broke. This fact could be confirmed by looking at thousands of different news stories. 92% of employed Americans were cutting back on spending. Not the unemployed, the employed. People with jobs were struggling to make ends meet. Their standard of living was crumbling right before their eyes. The teacher remembered asking his high school students a simple question years ago. He asked them to name one asset. They couldn't do it. Not a single student could name an asset. But when he asked them to name a liability, the answers came instantly and easily. Cars, phones, loans, credit cards. The list went on. He had tried to teach them an important lesson back then. He explained the difference between assets and liabilities. Assets put money in your pocket. Liabilities take money out. Throughout your entire life, you should be collecting assets, not liabilities. Not fancy new phones that fold, not the latest gadgets that cost a fortune. After 17 years, the masses were finally getting excited about folding phones. Technology he had owned for decades. The newest phones were incredibly thin with 3 screens. But he didn't need that fancy stuff. Well, maybe for trading he did. But for everyday life, absolutely not. The key was to resist buying fancy things and instead buy real assets. Stocks, gold, homes, silver, copper, platinum. These were assets that held value. These were things that protected wealth over time. This was how the wealthy played the game. This was what Donald Trump did. This was what every millionaire and billionaire understood. They bought assets first, then they took on debt at 3 or 4% interest. No taxes triggered, no taxable events created. Just wealth building silently in the background. The crisis was unfolding in real time, and very few people understood what was really happening. Money market funds were flowing while governments continued their deficit spending spree. Household debt was climbing worldwide, reaching levels never seen before. But here's what most people didn't understand. There was good debt and there was bad debt. The difference was everything. When someone owned real assets, properties, precious metals, commodities, then debt became a powerful tool. It became good debt. But the financial gurus on television and social media kept preaching the same old message. Dave Ramsey, a man respected by millions, told people to buy a house and pay it off in 15 years. Great advice for beginners. Baby steps for normal people who didn't know any better. But then what? After the house was paid off, what came next? Don't buy gold and silver, they said. That's stupid, they claimed. Just put everything in the S&P 500 or NASDAQ. Stay away from Bitcoin at all costs. This was the standard advice being given to millions of trusting Americans. The trader had paid off his houses long ago. He had moved beyond the baby steps. He understood something crucial that most people missed completely. In a debt-based monetary system, nothing was ever truly paid off. When the government printed money endlessly, when they made the money printer go brrr, the game changed entirely. He remembered explaining this concept in yesterday's video using a simple example. Everyone complained about expensive vacations to Las Vegas. Silver was up significantly, but people were thinking about it all wrong. It wasn't that silver had gotten more expensive. The purchasing power of $100 had actually fallen by 164%. Everything seemed expensive because the dollar was dying right in front of everyone's eyes. Silver had risen by exactly 164%. The numbers matched perfectly. These same percentages could be tracked throughout the entire economy. That's why saving in physical assets made sense. When financial advisors said save your money, they really should have added an important detail. Don't save in dollars, dummy. Unless the dollar looked like a silver coin, of course. That was $1 of silver. The purchasing power of that single dollar of silver told a completely different story than paper currency. Sometimes, assets took time to reflect inflation properly. There was a bullwhip effect where prices caught up slowly. Well, it looked like silver's time had finally arrived. He could use complicated words like inflation and deflation, but the truth was simpler. One silver dollar from the 1920s versus 102 paper dollars today. Congratulations to everyone holding cash. They had lost 99-point-something% of all their purchasing power. Meanwhile, that silver dollar from the 1920s, it still held its value. Actually, it had gained tremendously. Silver stayed at $1 until a very specific date in history. December 1971. That was when Tricky Dick Nixon made his move. He asked a question that would change everything. Do we really need to have this gold and silver thing anymore? The people would trust the government, he claimed. Americans didn't need to exchange paper notes for physical gold and silver. They didn't need to walk into banks and say, hey, this paper says you owe me silver. Hand it over. Nixon told everyone they didn't need that protection anymore. At least not until the day when the fire alarm went off. Well, that alarm was ringing loudly now. The people wanted their coats back from the coat check. The people wanted their silver back from the bankers, and the bankers didn't have it. Breaking news was spreading across social media platforms. Posts and articles were calling it a full-blown currency collapse. Well, kind of. How could something collapse more than 99.5%? It was already nearly worthless. But technically, yes, the collapse was accelerating. For everyone getting excited about what was happening with silver, there was an important historical lesson to remember. The last time this happened, stocks had dropped 58%. A massive crash had wiped out trillions in wealth, and right now all the indicators were suggesting the market might be topping again. Might be. As any experienced trader knew, it was always think and might, never certainties. Just probabilities and possibilities. This could be one of the greatest short squeezes on silver in financial history. Everyone had been waiting for this moment for years. A shiny silver coin sat on the desk, catching the light perfectly. Clean fingernails held it up for inspection. Gentlemen always kept their nails clean. It was important. This coin represented more than just metal. It represented a philosophy, a way of life. This was the way forward. Everyone remembered the last short squeeze attempt. The retail traders had rallied together, trying to force the banks into submission, but they hadn't possessed enough collective power to squeeze the massive institutions. Not back then. This time felt different. The pressure was building from multiple directions simultaneously. Bitcoin would probably keep rising forever. Silver would probably keep climbing. Gold would continue its upward march. The stock market? Well, that was another story entirely. It had pullbacks, serious corrections that wiped out fortunes overnight. Understanding what the Nasdaq was doing right now required looking at specific technical signals. The top had formed up there on the chart. Price needed to break above it decisively. How did experienced traders know it was actually a top? Simple. The indicator turned purple, then price closed below the key level, the Bravo 9. From there, smart money rode it all the way down to the major trend line. Thousands of dollars in profit just from one strategic trade. After hitting that trend line, something interesting developed on the chart. A rising wedge pattern formed gradually. This technical formation was bearish, signaling weakness despite higher prices. When price eventually broke below that supporting line, it would drop hard. The indicators showed exactly where it was headed. First target hit, then the second target, then straight down to the third level. This correction was actually healthy for the market. Pullbacks were necessary and welcome. They shook out weak hands and created new buying opportunities for patient traders. Silver presented similar dynamics, but with its own unique characteristics. A student being coached had recently made an important decision. He had switched from trading Nasdaq to focusing primarily on silver. The Nasdaq had been his bread and butter for years. Looking back at last year's price action told the whole story. That yellow trend line showed everything. Price came up, tested it, but couldn't break through convincingly. Smart traders made truckloads of money on the way down. Just saying. The student and his mentor had moved to trading silver on the 2-minute time frame. The results spoke for themselves. Entered the first trade, made $600, exited at $625, walked away with $1,225 total. Not bad for a few hours of focused work. Here's the real secret for making serious money on silver and gold. Trade the futures contracts. Someone might say they're broke and can't afford it. Fine. Trade smaller contracts. Go buy physical silver too. But understand this fundamental truth. Clicking buttons on a screen generated far more profit than walking into a silver shop and buying coins. Physical silver sat on the desks looking pretty. It would always be silver. Beautiful, but static. For anyone wanting to build truly massive stacks of wealth, actual work was required. Learning technical analysis, understanding market structure, studying chart patterns and indicators. Traders could pull up their platform, click on metals, select silver, and watch the 1-minute or 2-minute charts dance across their screens. Weird things appeared on trading charts sometimes, lines hanging around from previous sessions when the trader was working on daily timeframes. The mechanics were straightforward once someone learned the system. Pull up the chart, identify the key levels, wait for the setup, execute the trade, manage risk properly. For the silver stackers out there, an important warning needed attention. The chick magnet indicator down on the lower part of the chart wanted to pull price back down. This was crucial information. The white line represented current price on the 2-minute silver chart. Price was currently hanging up here, almost exhausted from its run. But stackers had just experienced an epic swing in silver prices. The chart showed the complete story. Price got beaten down initially. Then the eyes indicator came on. That was the notification signal. Get ready, something big is coming. Then it popped. Price ran straight up aggressively. Eyes came on again at the top. The whale watcher indicator confirmed institutional activity. When price got overly stretched, the notification warned traders to prepare for a reversal. Smart money already knew what was coming next. When price crossed below the 9 moving average, the move was massive. Over 2% down, then 2% back up. On one single NASDAQ contract that represented $25,000, a $50,000 move down, another $50,000 move up, $100,000 total from just understanding chart movements and timing entries correctly. Trading futures with leverage meant traders did not actually need the full $100,000 sitting in their account. But here's the critical part. Anyone who didn't know how to do this properly could lose everything quickly. The link in the description led to a comprehensive course. It looked expensive at first glance, but for $399, students received 2 complete courses covering everything needed. The course included detailed information about artificial intelligence integration in trading. The current account balance displayed $231,000. Students watched it grow steadily. What percentage gain was that? 2.1%. Some people might think that sounded terrible. 1% daily return seemed small and insignificant. But here's the reality check. 1% per day for an entire year was not simply 365% annual returns. The math worked completely differently because of compounding. For traders complaining their accounts weren't moving up thousands daily, the question was simple. Did they have $250,000 in their trading account? Percentages mattered more than raw dollar amounts. The key was learning to drive the vehicle properly. Multiple vehicles existed for wealth building. Self-driving vehicles, automated trading systems, went out constantly making money. Meanwhile, the trader kept buying physical assets: copper, silver, gold, stocks, homes, vacant land parcels. The strategy remained consistent. Buy low, sell high. 98% of people were asking the wrong question right now. They wondered why anyone would want to get into real estate this year when the market looked horrible. Ding, ding, ding. That was exactly when smart money moved aggressively. When everyone else panicked and ran away, that created the best opportunities. The same principle applied to silver. Smart buyers accumulated below $30 per ounce. When silver hit $100, those same buyers would double or triple their money, taking profits at the top while everyone else rushed in late. Bitcoin followed identical patterns. When everyone screamed, "Bitcoin is dead, stay away," that was prime buying time. They were probably buying Bitcoin at $127,000 during the euphoria. Right now, it traded at $97,000. The important question, was Johnny Bravo buying it currently? No. Did Johnny Bravo hold Bitcoin? Yes. Where would he buy more? Low. When would he sell or take profit? High. And when that happened, his audience would probably say negative things in the comments. But the chart told him exactly what was happening. The current formation was okay. A bull flag pattern was developing clearly. Someone in the comments section had mocked him recently. "So much for your bear flag prediction," they wrote sarcastically. But no, price was still inside the pattern, still following the expected path. Price would climb up to that yellow resistance line and face struggles there. Then the blue line would create problems. Then the purple 200-day moving average would provide resistance. And the chick magnet indicator wanted to pull price back down. All struggles. When price finally reached the highest level, it would also be severely overbought. More struggles ahead. Was he buying Bitcoin now? Absolutely not. The bigger elephant in the room needed acknowledgement. If price broke out of this consolidation pattern cleanly, fine. Then no struggle. Then bulls were in complete control. But he was drawing something important for a friend who was also a course student. He marked the left shoulder on the chart, then the head. Then, just for everyone watching, he drew in the right shoulder. A classic head and shoulders pattern forming. Come on up there, Bitcoin. Pull everyone in. Get all the normal people excited and emotional. Where were all these people when he was taking profits at the top? When he was screaming at everyone to get out? Right there. That was the exit point. They called him stupid back then. But supply and demand never lied. The fundamentals of scarcity, only 21 million Bitcoin would ever exist. Someone commented today asking why they should trust a guy who sells a trading course. Why even battle these comments? The timing was uncertain, but the big picture was crystal clear.